Silver's 10-month winning streak, gold's 7th straight record. And this streak is historic, I'm assuming. But here's what they're not telling you. Right now, at this very moment, 3 things are happening simultaneously that haven't aligned since 1980. Oil, gold, silver, all spiking together. China just ordered an immediate evacuation. $650 billion moved in hours. The informed money is positioning for something the mainstream won't discuss until it's too late. And if you don't understand what's coming next, you're about to watch the biggest wealth transfer of this decade happen. Without you, welcome back to Currency Archive. Now, before we dive into what's really happening behind these numbers, I need you to do something for me. If you've been watching the markets for years, maybe decades, you know that moments like this, they don't come often. So click that subscribe button right now, because what I'm about to show you, you won't find anywhere else. And drop a comment below. Tell me, where are you watching from today? New York, London, Dubai, Mumbai? Let me know. Because what's coming, it's going to affect every corner of this world. Now, let's talk about what just happened. February closed with a number that made seasoned traders pause. Silver finished the month in green for the 10th consecutive time. 10 months without a single red close. The last time silver demonstrated this level of persistence was during the run into 1980, when it climbed from $6 to $50 in just 18 months. But silver was not alone in making history. Gold just recorded its 7th straight monthly record close, the longest streak since 1973. Western spot prices hit $5,277. In just 2 months of this year, gold surged 22%, silver climbed 31%. These are not normal movements, and the market knows it. What caught the attention of informed analysts was not just the precious metals performance, but what was happening across the broader commodity complex. Oil, gold, and silver were all spiking together. When hard assets across different sectors move in lockstep, when energy, monetary hedges, and industrial metals all rise simultaneously, they are pricing the same underlying reality. Geopolitical risk, currency instability, supply chain vulnerability. At $72, the majority was screaming collapse. At $94, that same majority was screaming all-time highs by next week. This is human psychology in its purest form. The informed minority was accumulating when sentiment was bearish, while the reactive majority chases price after the move has already begun. $650 billion was added to the precious metals market capitalization in a matter of hours. That kind of capital deployment does not happen randomly. It happens when institutional participants are hedging against scenarios most public analysts refuse to discuss openly. The charts were telling one story, the fundamentals were telling another, but the positioning, the actual flow of capital, was telling the real story. Markets were not reacting to current events. They were pricing what informed money believed was coming next, and what was coming required understanding more than technical patterns or historical comparisons. It required understanding why 3 critical asset classes were moving together, and what that convergence actually meant. While headlines focused on price levels, the real story was unfolding in the correlations. Oil does not typically move with gold. Gold does not usually track silver tick for tick. Yet there they were, rising in perfect synchronization. This was not coincidence. It was confirmation. When energy markets spike alongside monetary metals, the market is pricing a specific type of disruption. Not inflation alone, not demand alone, but fragility across multiple critical systems simultaneously. Oil represents the lifeblood of global commerce. Every supply chain, every manufacturing process, every transportation network depends on energy stability. Gold represents monetary trust, or the lack of it, a hedge against currency depreciation and systemic financial stress. Silver bridges both worlds, serving as both a monetary asset and an industrial necessity. When all 3 move together, informed capital is hedging against scenarios where energy becomes scarce, currencies become unreliable, and industrial supply chains face disruption. The Shanghai premium on silver reached $12. That number deserves attention. When Eastern markets are willing to pay $12 above Western spot prices, it signals physical demand that futures markets are not capturing. It signals accumulation that is not speculative, but strategic. Then came the geopolitical catalysts. Trump declared dissatisfaction with Iranian negotiations. The State Department confirmed Iran had begun taking American hostages. China issued immediate evacuation orders for its citizens in Tehran. These were not isolated events. They were escalating pressure points. And the market responded before the headlines turned critical. $650 billion in capital moved within hours. Not days, not weeks. That kind of velocity indicates institutional positioning. Central banks, sovereign wealth funds, entities that move based on intelligence, not sentiment. They were not reacting to events. They were positioning ahead of them. This is how markets function when participants price tail risk before it fully materializes. The technical charts showed breakouts. The fundamentals showed strength. But the real signal was in the behavior, the coordinated movement across uncorrelated assets, the urgency in the capital flows. Something was being priced that public discourse had not yet acknowledged. Most observers were asking the wrong question. They wanted to know if war was coming, if markets would crash, if precious metals had peaked. But informed participants were not asking if, they were calculating what happens when. The distinction matters. Consider the mechanics of oil supply disruption. The Strait of Hormuz handles 21 million barrels per day, roughly 20% of global petroleum flow. If that corridor closes for even 72 hours, refineries across 3 continents begin rationing within a week. Shipping costs do not just rise, they multiply. Insurance premiums on tankers passing through conflict zones can increase 500% overnight. These are not theoretical scenarios. They are documented responses from previous geopolitical flare-ups in 2019, in 2012, in 2008. The difference now is the level of pre-positioning. Markets were not waiting for disruption to occur before pricing it in. Currency depreciation scenarios were already being modeled across major economies. When hard assets outpace equities by 30% in 2 months, capital is rotating out of paper promises and into tangible stores of value. This reflects a loss of confidence, not in individual currencies, but in the stability of the entire monetary framework. Independent analysis became critical at this juncture. Consensus forecasting had failed repeatedly over the past 18 months, calling tops that never materialized, predicting corrections that never came. The majority accumulated when prices were elevated and sold when prices were compressed. The informed minority operated in reverse. They understood accumulation phases versus distribution phases. They recognized that structural shifts do not announce themselves with headlines. They announce themselves through positioning. Risk management during regime change requires different thinking. Traditional diversification assumes mean reversion. But when correlations break down, when assets that normally move independently suddenly move together, mean reversion models fail. Strategic allocation during this environment meant understanding asymmetric opportunity. Small positions in hard assets, held through volatility, had historically delivered returns that equities could not match during monetary instability. The 1970s proved this, the 2000s confirmed it. And now, the 2020s were testing whether the current generation understood the lesson. Preparation was not about prediction. It was about positioning before the crowd recognized what was unfolding. The next 6 to 18 months would reveal whether this was a temporary spike or a structural shift. 3 scenarios existed, each with distinct probability weightings. The base case assumed continued geopolitical tension with contained escalation. In this scenario, precious metals consolidate recent gains. Oil stabilizes between $80 and $95, and markets enter a ranging pattern while participants assess developments. Gold holds above $5,000, silver maintains support above $30, but explosive upside remains limited without further catalysts. Probability, 60%. The upside scenario involved diplomatic resolution. Tensions de-escalate, Iran returns to negotiations, shipping routes remain secure, and risk appetite returns to traditional growth assets. Precious metals correct 10 to 15% as capital rotates back into equities and credit markets. Probability, 20%. The downside scenario, which paradoxically represented upside for hard assets, involved escalation, military engagement, supply disruptions, currency instability across emerging markets, and a flight to safety that accelerates precious metals beyond historical resistance levels. Gold tests 6,000 within quarters, silver challenges $50 within 12 months, and oil spikes above 120. Probability, 20%. Tape readings suggested the next technical objective for gold sat near 5,400. Silver faced resistance at 34, but a clear break above that level opened 40 as the next logical target. These were not predictions. They were probability-weighted scenarios based on historical price behavior and current market structure. What mattered now was monitoring leading indicators: central bank gold purchases, Eastern physical premiums, oil inventory levels, shipping insurance costs, currency swap line usage. These data points separated signal from noise. Independent thinking required rejecting herd mentality, whether bullish or bearish. The crowd that panicked at 72 missed the entry. The crowd chasing at 94 would likely panic on the first pullback. Wealth transfers during major market transitions favor those who position early, hold through volatility, and understand that asymmetric opportunity requires asymmetric patience. This was not about calling tops or bottoms. It was about recognizing when fundamentals, technicals, and capital flows align. That alignment was happening now. The only question remaining was whether observers were positioned or still deciding.